Hello, learners. I hope all of you are doing great. So, today in the accounting session, we will be discussing the basic accounting principles and the concepts. Okay, so there are 7 concepts and 4 principles. The principles are conservatism, consistency, materiality, and objectivity. And the concepts we will see. So, we'll start our discussion. The first concept is business entity concept. That is, otherwise it is termed as separate entity concept. A business is considered a separate entity from owners and should be treated separately. Any personal transactions of its owner should not be recorded in the business accounting. So it's clear that the owner's personal transactions will not be recorded in the in the accounting, will not be recorded, because the business and the owner are treated as separate entity. They are two different separate firms. And if you want to record, if there are certain transactions related to the owner into the business, that will be recorded unless the personal transaction involving the personal transaction of the owner is adding or withdrawing resources from the business. That if the owner itself is an employee of the organization, he have to be paid the salary, or otherwise if he have taken some membership, he have to pay something to the business or to the organization so that he can take the membership. So those kind of transaction will be recorded. That is the owner's personal transaction, those which are involving or which are adding or withdrawing resources from the business or into the business, those kind of personal transactions will be added. Otherwise the business and the owner is treated separately. They both are separate entity. So I hope the first concept, this business separate entity concept is clear. Now we'll see the second concept, that is going concern concept. So it says it assumes that an entity will continue to operate indefinitely. Indefinitely means for a long time, indefinite time. In this basis, generally assets are recorded based on their original cost and not on the market value. So we will be recording the cost of the assets that we bought based on the original price, not on the future price or on the present value of the asset. It is always recorded based on the price at which we have bought it. Okay, at what time we bought the price, we will be valuing the asset on the basis of the price that we paid at that time. Okay, assets are assumed to be held and used for an indefinite period of time or during its estimated useful time, and that assets are not intended to be sold immediately or liquidated. Okay, so assets, once we buy the assets, we will be buying that for a long term period. Okay, most of the machineries, for example, the assets include the machineries, land, labor, all those things. So that assets we are buying, or we are getting the assets thinking, or we will be holding that for a long term period. So the assets are not intended to be sold immediately or liquidated. So such kind of assets are valued based on the original price. Okay, so that is a going concern concept. Now we will see the third concept, that is monetary unit. What does this monetary unit say? From the term itself, it is understood that all the transactions in terms of money value, every transaction will be recorded in terms of some money value. That may be Indian rupee, that may be dollar, that may be euro, or anything. So the business financial transactions recorded and reported should be in monetary unit. Thus, any non-financial or non-monetary information that cannot be measured in a monetary unit are not recorded in the accounting books, but instead a memorandum will be used. So if there are certain transactions that have to be recorded in the books of account which are not of money terms, which are non-monetary terms, that will be recorded in the books of account as a memorandum. We will be using a memorandum to record those transactions in the books of the account. Okay, now the fourth concept is historical concept. a business resource acquired should be valued and recorded based on the actual cash equivalent or original cost of acquisition, not the prevailing market value or future value. Exception to the rule is when the business is in the process of closure or liquidation. So before also we have seen that the assets purchased, the assets will be acquired, will be valued or recorded based on the original price, the price at which we acquired that. So except this concept is giving an exception if suddenly the business or the organization is under the edge of closure or liquidation, then the valuation of the assets will be done based on the present value, the present market value. Otherwise all the costs are calculated on the historical, will be calculated on the basis of the original price, the price at which the assets or the item are occupied. Okay, next concept is matching concern concept. So in matching concern concept, this principle requires that revenue recorded in a given accounting period should have an equivalent expenses recorded in order to show the true profit of a business. So we know the equation of revenue recovered is equal to income minus expense. So to identify what is the exact profit, otherwise we can solve the call the revenue as a profit, the profit equal to income minus expense. So what are the income, what are the income we received, we will be minusing the expense part from the income, so that we will get the true value of the profit. So matching concern says that the expense and the income should be matching, so that what all the expenses incurred and what all the income incurred should be matching, so that we can realize the real profit. Okay, now the sixth concept is accounting period. Okay, this principle entails a business to complete a whole accounting process over a specific operating time period. We have seen all the final accounts or financial statements are prepared for a particular period, maybe for 1 month, maybe for a particular period, like 1 year. Balance sheet is mostly prepared for a particular year. The trial balance may be prepared for a particular year or particular quarterly, maybe for monthly. Like actually these financial statements, everything will be made, the books of accounts, we will be recording all the transactions for a particular period, maybe monthly basis, maybe daily basis, maybe for an year, maybe quarterly. But whatever be the like accounting things, we will be entering for a particular period. The accounting period may be monthly, quarterly or annually. For annual accounting period, it may follow a calendar or a fiscal year. You know, financial year we call. Most of the financial year starts from April until March. Okay, now we will see the accrual concept. This is the final concept, that is the seventh concept. This principle requires that revenue should be recorded in the period it is earned, regardless of the time the cash is received. The same is true for expense also. The expense should be recognized and recorded at the time it is incurred, regardless of the time that cash is paid. It is to show the true picture of the financial performance. That is accrual basis. Initially we have seen the basis of accounting systems, that is cash basis and accrual basis. In cash basis we will be recording the transaction only when actual cash transactions are happening. In accrual basis we will be recording the transaction, and like it is like on accrual basis we will be, regardless whether we received the cash in actual, if at all we didn't receive the cash in actual, we will be entering the transaction in this accrual basis concept. Now we will see the 4 principles of accounting. So the 4 principles are conservatism, consistency, materiality and objectivity. So the first one we will see, the conservatism principle says, this principle states that given 2 options in the amount of business transaction, the amount recorded should be the lower than the higher value. Like we have to enter the lower value than going for the higher value. If we value some certain business transaction, we have to, the amount recorded should be the lower than higher value. Okay. And consistency says this principle ensures similar and consistent recording procedures is used by the business year after the year unless change is necessary. Like we will be following same pattern unless and until and unless there is a change, actual change is necessary. Consistency allows reliable comparison of the financial information between two accounting periods. So because if we are following same kind of pattern of accounting procedures, then it is easy for us to compare the accounting 2020 and 2021. If we want to compare the financial transaction and the financial worth of a particular organization, if you are maintaining same kind of financial accounting, or the accounts are the entering and the recording are done in the, if we are following the same kind of principles, then it will be easy for us to analyze, or if it will be easy for us to compare also. Okay, so if you want to compare to accounting periods financial nature or financial statement, then it will be easy if we follow the consistency principle. Now we'll see the materiality principle. Business transactions that will affect the decision of a user are considered important or material, thus must be reported properly. This principle states that errors or mistakes in accounting procedures that which involves immaterial or small amount may not be needed attention or correction. So material, if there is certain important things to be considered, that only will be considered, that are of material nature. Immaterial nature things, until and unless that is adding more value, we will not be giving more attention and more corrections will not be done. Okay. And the final principle, the fourth principle is objectivity. This principle states that the recorded amount should have some form of impartial supporting evidence or documentation. It also states that recording should be performed with independence that's free from bias and prejudice. So in this it says that this principle states that when we are recording certain transactions, it should be free from biases, prejudice, and it should be independent. Like recording should be done on true basis. Okay, and there should be certain supporting evidences on documentation. There is once we receive certain when we go and buy certain items, we will be asking for the receipts. It's for a documentation purpose. If we give certain payments, the other people will be asking for certain receipts or certain documents. So this documentation helps if there is further checking future financial analysis and references. For this purpose, this documentation, this supporting documentation evidences, if we keep, that will be helpful. So these are the accounting basic principles of accounting, the principles and concepts involved in the accounting. I hope this session is clear to you all, and if you feel any difficulty, get back to me. So thank you all.